G'day mate. Everyone talks about passive income, but almost no one shows you the exact math on how to actually get there. Today, we are stripping away the hype. If you want to wake up, check your phone, and see that your money has made you an extra $1,000 every single month, you don't need to invent an app, and you don't need to buy a real estate empire. You just need a perfectly balanced ASX ETF portfolio. By the end of this video, I'm going to give you the exact blueprint for a $100,000 ETF portfolio that balances aggressive growth with heavy-hitting monthly income. Welcome back to ETF Insights Australia. Let's run the numbers. First, let's look at the cold, hard math. To make $1,000 a month, you need $12,000 a year in pure dividend distributions. If you just dump your money into a standard, broad market index fund yielding around 4%, you'd need a massive $300,000 invested. That is a huge mountain to climb. But what if we strategically blend high-yield Aussie ETFs with global growth? We can push that portfolio yield higher, while still capturing capital growth. We are going to build a hypothetical $100,000 portfolio today. It won't hit $1,000 a month immediately, but I'm going to show you how this specific mix accelerates your compounding so you hit that goal years faster than a standard savings plan. Every portfolio needs a rock-solid foundation, and for Aussie income investors, it's hard to beat Vanguard's VHY. In our $100,000 blueprint, we are allocating 40%, or $40,000, right here. Why? Because Australian companies are some of the most generous dividend payers on the planet. VHY bundles together the absolute heavyweights, the big banks, BHP, Woodside, companies that spit out cash. But the real secret weapon here is franking credits. Because these companies have already paid Aussie corporate tax, you get a tax credit attached to your dividend. That 4.5 to 5% cash yield you see on paper? When you gross it up with franking credits, it often behaves more like a 6.5% return. This is the engine of our income. If you only focus on high yield, your portfolio will slowly die due to inflation. You must have capital growth. That's why 35% of our portfolio, $35,000, is going directly into NDQ. This gives us the top 100 non-financial companies on the NASDAQ. We are talking Apple, Microsoft, Amazon, and Nvidia. While NDQ doesn't pay a massive dividend, usually around 1%, the capital growth over the last decade has been completely explosive. By holding NDQ alongside VHY, we ensure that the total value of your $100,000 portfolio keeps growing year after year, protecting your wealth from inflation while the Aussie side handles the heavy lifting for your income. Now we need to inject some serious monthly cash flow into this setup. For the final 25%, or $25,000, we are using YMAX. YMAX is a bit different. It's an actively managed ETF that holds the top 20 Australian stocks, but it uses a covered call strategy. Without getting too deep in the weeds, they essentially trade away some of the extreme upside growth potential in exchange for massive, immediate income. We are talking target yields historically around the 7 to 9% mark. And the best part? It pays out monthly. This is what smooths out your cash flow so you aren't waiting 3 months for your next dividend check. So, here is your finalized $100,000 blueprint. You have VHY providing tax-advantaged Aussie dividends. You have NDQ securing aggressive global growth. And you have YMAX injecting high-yield monthly cash flow. With this exact $100,000 mix, assuming historical averages, you could be looking at an overall portfolio yield pushing 5.5% to 6%, plus strong capital growth. That's roughly $5,500 to $6,000 a year in pure passive income, right from day one. To hit our $1,000 a month goal, you just take those dividends, automatically reinvest them back into the ETFs, and keep adding your own savings. That is the compounding snowball effect. Once it starts rolling, it becomes unstoppable. Building a $100,000 portfolio is a major milestone, and having a strict, math-based plan is the only way to get there without losing sleep. But remember, this is general education, not financial advice. Always make sure a strategy aligns with your personal risk tolerance. If you want to dive deeper into monthly income, check out my video right here on the screen where I expose a massive yield trap that catches a lot of beginner investors. Click on that, and I'll see you over there. Subscribe ETF Insights Australia for more videos on investing. Thanks for watching and happy investing.